Hello, it's Tuesday, October 29th, 2019, just 2 days from Halloween. I'm Steve Houston with Compass Communications, and I'm here again with Joe Terrell of Terrell & Company. And Joe, we're going to talk a little bit about money and investing and the economy. Let's start this. Is there anything different in the outlook for the economy that we discussed from our last meeting?
Not really. The economy is chugging along worldwide, and it has been hurt a little bit by business confidence falling. That's directly attributable to businesses not knowing how to make multi-year decisions when they have no idea what tariffs may be, what rules on international trade may be. So businesses are definitely postponing spending. That's hurting the economy a little. But around the world, the consumer is in great shape, and the consumers carry in the day. Consumers are out spending money, traveling, buying houses, cars, and therefore the overall economy is doing just fine. It would help if we get some type of definitive trade agreement and we can get some confidence that we're not going to have trade wars.
Let's talk about something that we talk about frequently. The human behavior being what it is. People tend to look and make decisions based on the 24/7 news cycle as opposed to long-term 1, 2, 3-year trends that they can see if they want to research it. So yesterday was a great example. The S&P 500 hit an all-time record. People were really excited. But earnings growth is actually slowing over the long term. What is your perspective on this?
We're in an environment, Steve, where overall volatility in the markets has never in history been this great, particularly within individual issues. We are in what I think is a fad that will eventually fade away of people wanting to play momentum. And if there's a headline on a company or an industry or a political event, whatever it may be, that makes people think today, and you've called it the 24-hour news cycle, computers are programmed to chase that particular stock, sell it, buy it, and it creates tremendous volatility. Same thing with earnings. This is earnings season. Companies that come out and report better than what people think, get the momentum and they go up. Sometimes, depending upon what they said about the future, they can go down. The lesson in this to be learned is try and ignore that. Try and ignore these very short-term cycles. Try and ignore the fact that yesterday the market made a new record high by inches, barely, not even 1% higher than where it was 18 months ago. So concentrate on investments that you think 2 or 3 years from now are going to be good investments that will provide you with a nice rate of return, and ignore the fact that maybe for the moment those companies are not in favor. The market's attention span is very, very, very short. They're off chasing something else. Don't get caught up in that. Over the 40 years I've been in this business, the number of times that people want to figure out how can I chase momentum. This is going up, buy it. And going up means the price is higher. They tend to buy high. Oh, but this is going down, sell it. you know, it seems to people like that's common sense, and now they got computers to automatically do it. A lot of institutions are going this direction. But what you're really doing is you're buying when things are high, you're selling when things are low, and over a period of time, that's not going to work.
And as you and I have talked, there are companies that are simply not making the headlines. They're buying back stock, they have a lot of cash, but they just don't have enough panache to make the headlines. What are your thoughts?
Oh, that's very true, very true. The last couple of years have seen markets that wanted companies that were growing sales-wise at 30, 40, 50%, even though those same companies were not making money, not generating any positive cash flow, not paying any dividends, but people's expectations, oh my God, look at the momentum, look at the growth. Some of the business models of these companies will never allow them to make a profit. But yet people continue to chase these FANG stocks and growth stocks. That's beginning to change. People are moving back towards the more mundane industrial companies because maybe their sales are only growing at 2 to 3%. However, they are making real money. They're buying back a great amount of their stock, which is the same thing as having a stock split, only in today's world for tax efficiency they buy back stock, increasing cash dividends, increasing cash flow, paying down debt. These are all big positives that lead you to these companies that are only growing, as I say, 2 to 3%. And in that, I think you can put such companies as an international paper, the airlines, some of the pharmaceuticals. Again, you're not going, the banks are very classic. You're not going to get 10%, 15% growth from a Citicorp. However, they bought back 20% of the entire company just in the last 2 years. They'll buy back another 10% in the next 12 months. That's retiring 1/3 of all the stock that is outstanding. That is the same thing as increasing my ownership as if it was a 2-for-1 split. They're increasing the cash dividends. Why are these not a better investment, even though they're not going to have that big growth rate?
So we'd be remiss if we didn't talk a little bit about the Fed, which tomorrow is widely anticipated is going to lower interest rates for the 3rd time in as many meetings this year. What are your thoughts?
Okay, you're going to get me.
Let's keep it brief.
Well, I'll try to keep it brief because the Fed is doing the wrong thing. Interest rates as a function of the growth of the economy, the growth of inflation, and et cetera, are very historically low right now. And the interest rate is not holding back the economy. There's not anyone out there that feels, gosh, 3% is too high of an interest rate, but if they ever fell to 2%, I'm going to go out and borrow a lot of money and build new plant and equipment and hire more people. The cost of money is not in any way holding back the economy. So what has happened is the Fed has always made decisions predicated upon the economy and again, how well is the economy doing, unemployment. These were the things that the Fed made their decisions on. All of those things, unemployment is at record lows, consumer is doing as well as they've ever done in the past 40 years, the economy is growing, inflation is running 1.5% to 2%. It's not like we're stuck in a big deflationary environment. Put all those things together, it says there's absolutely no need to cut interest rates. Why is the Fed cutting interest rates? They're giving in to political pressure. They are listening too much to the markets. They're not making decisions based upon fundamentals. They're making decisions upon, well, market participants are worried about the trade war. Maybe we'd better cut interest rates to help out. Well, the markets are worried about Brexit and what's going on in Europe. Or the markets are simply down because people are worried about the U.S. economy as what got this latest round of Fed rate cuts going. So, in my opinion, it's a very potentially damaging precedent that the Fed is sitting here of saying we're going to operate monetary policy predicated upon what the markets want us to do rather than what the fundamentals are calling for.
Thank you, Joe. That's Joe Terrell, founder of Terrell & Company, independent wealth management with $700 million in discretionary assets under management. Joe, let's visit again, maybe around Thanksgiving time, and see where everything's going.
Yes, we'll see if we get in Chile coming up. China and the United States are expected to sign phase one of a trade agreement. We'll see if that happens, and if so, what it actually says.
Okay. And everyone have a happy and safe Halloween. Thank you.